the mistakes you will make not buying deals will be greater than the mistakes you make missing deals.
Grant Cardone owns over $4 billion in real estate that generates more than $80 million in annual cash flow, and he started with just $3,000. The shocking truth? The strategies he teaches publicly in the 10X rule aren't the ones he actually used to build his empire. While most real estate gurus are secretly losing money, Cardone has quietly assembled one of the largest private portfolios in America using methods he rarely discusses. Today, I'm revealing the real blueprint behind Cardone's wealth. Specifically, the 5 hidden strategies that transformed him from a car salesman to controlling over 40,000 apartment units. These aren't theories. This is the actual playbook he's used for decades while most investors struggle to buy even a single property. Let's start by addressing the elephant in the room. How did Grant Cardone really build a multi-billion-dollar real estate portfolio? Not through the motivational content he's famous for, but through a methodical real estate strategy that few people truly understand. Cardone Capital now controls over 40,000 apartment units across multiple states. The portfolio generates approximately $80 million in annual cash flow, providing returns to thousands of investors while building Cardone's personal wealth. But the journey to this empire wasn't the overnight success many assume. What most people don't realize is that Cardone spent nearly a decade studying real estate before making his first significant investment. While he was building his sales training business, he was silently researching markets, property types, and investment structures. This period of preparation, which he rarely discusses in his motivational content, laid the foundation for everything that followed. The first major revelation about Cardone's approach is that it runs counter to most conventional real estate investing wisdom. While most real estate gurus advocate starting with single-family homes or small multifamily properties, Cardone skipped these entry-level investments entirely. He recognized early on that the real wealth in real estate comes from scale, and he structured his entire approach around achieving it as efficiently as possible. This perspective shift is crucial for understanding his portfolio. Cardone doesn't think like a traditional real estate investor looking to buy properties. He thinks like an institutional investor looking to acquire cash-flowing assets. This fundamental difference in mindset explains why his portfolio looks nothing like what most real estate investors aspire to build. The first secret behind Cardone's portfolio isn't what he bought, but what he deliberately avoided. While many investors chase Class A luxury properties or distressed Class C value adds, Cardone built his empire almost exclusively with Class B multifamily properties. These are quality apartment complexes in solid neighborhoods that aren't the newest or most luxurious, but provide stable occupancy with working professionals who can reliably pay rent. This focus on Class B properties is no accident. It's a deliberate strategy to maximize cash flow while minimizing risk. Class B multifamily hits what Cardone calls the sweet spot of real estate investing. The properties are new enough to avoid major capital expenditures, but old enough to acquire at reasonable prices. The tenant base is stable enough to maintain high occupancy, but cost-conscious enough to maximize net operating income. The numbers tell the story. Class A properties might command higher rents, but they typically deliver cash-on-cash returns of just 3 to 5% annually. Class C properties might seem like bargains, but management headaches and tenant turnover often reduce actual returns. Cardone's Class B portfolio consistently generates 6 to 8% cash-on-cash returns while still appreciating in value. What's particularly notable about this approach is its consistency. While many real estate investors diversify across different property types, some single-family, some retail, some office, Cardone maintains laser focus on one sector. This specialization has allowed him to develop systems and expertise that maximize returns in ways generalists cannot achieve. The lesson here isn't just about choosing Class B multifamily, but about the power of specialization itself. Cardone's portfolio demonstrates that becoming the absolute expert in one specific niche can be more powerful than being moderately good across multiple investment types. The second secret to Cardone's portfolio is its unwavering focus on cash flow above all other metrics. While many investors chase appreciation or tax benefits, Cardone structured his entire acquisition strategy around one primary goal: maximizing monthly cash distributions. This cash flow obsession manifests in specific acquisition criteria that few investors understand. Cardone targets properties with at least 200 units because this scale enables operational efficiencies that smaller properties cannot achieve. His team can negotiate better vendor contracts, implement more efficient property management, and spread fixed costs across more units. But the real genius is in his market selection. Contrary to conventional wisdom that advocates buying in the hottest, fastest-growing markets, Cardone looks for something different. He targets markets with three specific characteristics. 1. Population growth between 1 to 3% annually, enough to drive demand but not so hot that prices are inflated. 2. Job diversity across multiple industries to avoid dependency on any single employer or sector. 3. Landlord-friendly regulations to maximize operational control and minimize regulatory costs. This approach has led him to concentrate investments in markets like Atlanta, Houston, and Florida rather than chasing deals in high-cost coastal markets. The results speak for themselves. While many investors in high-appreciation markets are subsisting on thin or negative cash flow, Cardone's portfolio has consistently generated substantial monthly income even during market downturns. Perhaps most revealing is his acquisition metric. Cardone won't purchase a property unless it can deliver at least 6% cash-on-cash return from day one, without depending on future rent increases or appreciation. This conservative underwriting ensures his portfolio remains resilient even during economic challenges. The cash flow fortress strategy isn't just about making money, it's about staying power. By prioritizing consistent monthly income, Cardone has built a portfolio that can weather any economic storm while continuing to generate wealth regardless of market cycles. The third secret behind Cardone's portfolio, and perhaps the most misunderstood, is his sophisticated approach to leverage. While many real estate gurus advocate either extremely conservative financing or maximum leverage, Cardone has developed a nuanced middle path that maximizes returns while managing risk. Contrary to popular belief, Cardone doesn't follow the never-use-debt philosophy of some wealth advisors, nor does he maximize leverage like some aggressive investors. Instead, he typically finances properties with 60 to 65% loan-to-value ratios. Enough leverage to amplify returns, but not so much that a market downturn would create financial distress. What's truly revolutionary is his approach to debt structuring. Rather than accepting standard financing terms, Cardone negotiates custom loan structures with specific characteristics. 1. Extended interest-only periods, often 5 to 7 years, to maximize early cash flow. 2. Non-recourse lending to protect personal assets. 3. Assumable loans that future buyers can take over, enhancing exit flexibility. 4. Staggered maturity dates to reduce refinancing risk across the portfolio. This financing strategy creates what Cardone calls positive leverage, where the property generates more return than the cost of the debt, effectively making the lender a partner in wealth creation rather than just a service provider. Perhaps most impressively, Cardone has secured approximately $2.5 billion in financing without personally guaranteeing the majority of it. By structuring investments through his funds and using non-recourse debt, he's built an empire where the properties themselves, not his personal wealth, stand behind the financing. This sophisticated approach to leverage is a far cry from the simplistic, debt is bad, or maximize leverage, extremes often taught in real estate education. It represents a carefully calibrated strategy designed to optimize returns while maintaining portfolio resilience. The fourth secret to Cardone's portfolio is his revolutionary approach to raising capital. While most real estate investors rely solely on their own capital or traditional bank financing, Cardone pioneered a hybrid equity model that has allowed him to scale far beyond what would otherwise be possible. Through Cardone Capital, he's raised over $1 billion from more than 10,000 investors, effectively creating his own private equity fund without the Wall Street middlemen. This capital-raising machine has become so efficient that he can now acquire over $100 million properties without depending on institutional partners. The structure is ingenious in its simplicity. Investors contribute capital to his funds and receive preferred returns, typically 6 to 8% annually, plus a share of appreciation when properties are eventually sold. Cardone, meanwhile, receives asset management fees plus the majority of profits beyond the preferred return threshold. This model creates perfect alignment between Cardone and his investors. Both parties benefit from successful operations, and neither makes money unless the properties perform. It's a stark contrast to the traditional syndication model where sponsors often collect fees regardless of property performance. What's particularly remarkable is how Cardone leveraged his personal brand to transform capital raising. While traditional real estate investors might spend months securing financing for each deal, Cardone can now raise tens of millions in days through his established investor network. This capital efficiency gives him a tremendous competitive advantage when bidding on institutional quality assets. The equity multiple strategy isn't just about raising money, it's about creating a perpetual acquisition machine. By establishing a track record of consistent investor returns, Cardone has built a capital base that replenishes itself, with existing investors regularly reinvesting proceeds and referring others to his funds. This approach represents a fundamental evolution beyond traditional real estate, investing into something closer to private equity, but without the layers of fees and misaligned incentives that often plague institutional funds. The fifth and perhaps most underappreciated secret to Cardone's portfolio is his relentless focus on operational excellence. While many real estate investors treat property management as an afterthought, Cardone has built a vertically integrated operation that maximizes revenue while minimizing expenses across the entire portfolio. This operational focus begins with property selection. Cardone targets complexes with specific characteristics that enhance operational efficiency. 1. Properties with 200+ units to achieve management economies of scale. 2. Locations near major employment centers to ensure tenant demand. 3. Vintage between 1980 to 2005, minimizing capital expenditure requirements while providing value-add opportunities. 4. Existing amenities that can be enhanced rather than built from scratch. Once acquired, properties undergo what Cardone calls the institutional upgrade, a systematic enhancement process focusing on high ROI improvements rather than cosmetic renovations. This includes smart home technology, energy efficiency upgrades, and amenity enhancements that allow for premium rent positioning without excessive capital investment. On the management side, Cardone's team has developed proprietary systems for everything from tenant screening to maintenance requests. By centralizing certain functions while maintaining on-site teams for others, they've achieved operational efficiencies that most property managers cannot match. The results are remarkable. Cardone's portfolio typically achieves 1. Occupancy rates 3 to 5% above market averages. 2. Expense ratios 5 to 8% below comparable properties. 3. Tenant retention 15 to 20% higher than industry standards. 4. Rent premiums of $75 to $150 per unit above comparable properties. These operational advantages might seem small individually, but across over 40,000 units, they translate into tens of millions in additional annual cash flow. This operational excellence also creates a virtuous cycle. Better returns attract more investor capital, enabling further acquisitions and greater economies of scale. What's particularly impressive is how Cardone has systematized these operational advantages, creating standard operating procedures that can be replicated across new acquisitions. This scalable approach to property management represents a fundamental evolution beyond the mom-and-pop operations that dominate much of the multifamily sector. So what can the average investor learn from Cardone's portfolio? While few can replicate the scale of his empire, the underlying principles are adaptable to any investment level. Here are the key takeaways. First, specialize rather than diversify, at least initially. Cardone's focus on Class B multifamily allowed him to develop deep expertise that created competitive advantages. Rather than spreading yourself thin across multiple property types, consider mastering one specific niche before expanding. Second, prioritize cash flow above all else. The monthly income from Cardone's portfolio provided both financial security and reinvestment capital. This cash flow focus meant he could continue expanding even during market downturns when appreciation-focused investors were struggling. Third, use leverage strategically, not maximally. Cardone's approach to financing demonstrates that debt can amplify returns without creating excessive risk if structured properly. Focus on securing favorable terms rather than simply maximizing loan amounts. Fourth, consider creative capital partnerships. Even if you can't raise billions like Cardone, you can apply the principle of working with equity partners. This might mean bringing in friends and family on deals or forming small investment groups to tackle larger properties than you could acquire alone. Fifth, treat operations as a competitive advantage, not a necessary evil. Cardone's portfolio demonstrates that superior property management can significantly enhance returns. Even with a single property, implementing professional systems and processes can dramatically improve performance. Perhaps most importantly, recognize that building substantial wealth through real estate requires patience and scale. Cardone spent years studying markets before making his first major acquisition, and he consistently reinvested profits to achieve the portfolio size that now generates generational wealth. The truth is, Cardone's approach isn't based on get-rich-quick tactics or market timing luck. It's built on sound investment principles, operational excellence, and strategic scaling that any dedicated investor can apply, even if not at the same magnitude. Grant Cardone's real estate portfolio represents much more than just an impressive collection of properties. It's the manifestation of a deliberate strategy that combines institutional quality acquisition criteria, sophisticated capital structures, and operational excellence. What's particularly fascinating is how different this approach is from what most real estate educators teach. While many focus on creative financing techniques or short-term flipping strategies, Cardone built his empire through methodical accumulation of cash-flowing assets at institutional scale. The 5 strategies we've examined, Class B multifamily concentration, cash flow focus, leverage mastery, equity partnerships, and operational excellence, provide a blueprint that investors at any level can adapt to their own circumstances. Perhaps the most important lesson from Cardone's portfolio isn't about specific tactics, but about mindset. He approached real estate not as a side hustle or get-rich-quick scheme, but as a sophisticated business deserving of professional systems and strategic growth plans. As Cardone himself often says, success is not an event, it's a process. His portfolio didn't reach $4 billion overnight. It grew methodically through consistent application of sound principles over decades. The question isn't whether you can build a $4 billion portfolio like Cardone. The question is whether you can apply these same principles to achieve your own definition of financial success through real estate. If you found value in these insights, hit the like button and subscribe for more content that goes beyond the surface-level advice dominating most real estate channels. Drop a comment with your biggest takeaway, and let me know what successful investor strategy you want me to analyze next. Until next time, remember, the strategies that build real wealth are rarely the ones shared on stage at motivational seminars. They're the ones quietly implemented behind the scenes by those who understand that true success comes from execution, not inspiration.